Hello and welcome to AI Market News by LM.
All right, so this week there's really only one story that's driving the entire conversation and, moving global markets. And that is the potential end to this really lengthy US government shutdown. I mean, after weeks of just gridlock, it looks like there's been a breakthrough. And that has sent this huge wave of optimism through the financial world. We're seeing the effects of that ripple across pretty much every asset class out there. So let's break down what's actually going on.
So, the key thing to really get here is that almost all the big market moves we've seen this week, they can all be traced back to this one single development coming out of Washington. Seriously, it is the primary catalyst. It's the main event, and it's got investors everywhere just breathing this huge collective sigh of relief.
And, to really appreciate why the market is reacting like this, we've got to grasp the sheer scale of the economic damage we're talking about. The shutdown has been costing the US economy an estimated, get this, $15 billion every single week. That is a massive drag on growth, and it completely explains why the markets are jumping on any sign of a resolution. It feels like the financial bleeding might finally be stopping.
And look, this isn't just wishful thinking or speculation. We're talking about actual, concrete legislative action here. The Senate is pushing forward a new spending bill, and the whole point is to reopen the government. So for investors, this is the most tangible, the most real signal yet that a deal is finally within reach. And how are they showing their approval? Well, they're buying in. And that's sparking this big relief rally that kicked off in the US and is now spreading all across the globe.
Okay, so how does all this political news actually translate into market action? Well, the most immediate impact, the place we see it first, is in US equity futures. They just jumped as soon as the news broke. Let's take a look at the actual numbers.
Yeah, the gains here are pretty solid, right across the board. We've got the S&P 500 up nearly a full percent, but check out the NASDAQ 100, it's up a really powerful 1.5%. And this kind of outperformance from the tech-heavy NASDAQ, that's a classic signal. It's telling us that investor risk appetite is coming back, and it's coming back in a big way.
But of course, a story this big doesn't just stop at the US border. No way. This optimism is having a huge ripple effect all around the globe. And we can see that super clearly if we look at the foreign exchange markets.
So the US dollar is right at the center of all this action. On one hand, we're seeing the dollar-yen pair ticking higher, as traders are betting on a much healthier US economic outlook. But at the same time, the broader Bloomberg Dollar Index, that's the one that measures the dollar against a whole basket of currencies, it's actually been sliding a bit. Now this shows how complex the global picture is, right? Sometimes renewed optimism like this actually leads investors to move out of the dollar and into other, maybe riskier currencies. And this really illustrates that global connection perfectly. This relief rally is not just a Wall Street story. That positive momentum has carried right on over into the Asian trading session. We're seeing key indices like Japan's Nikkei and South Korea's Kospi both posting some really solid gains. Bottom line, a resolution in Washington is seen as a win for the entire global economy. It's boosting confidence far, far beyond US shores.
But here's the big question. Are these gains built on solid fundamentals, or is this all just fleeting emotion, a quick sugar rush? To even begin to answer that, we've got to look beyond the price charts and really dig into the underlying market mood. And a great tool for doing exactly that is what we call a sentiment indicator.
Now, one of the most well-known ones out there is the Fear and Greed Index. You can think of this tool as kind of like a market psychologist. It looks at a whole bunch of different indicators to figure out what's the dominant emotion driving decisions right now. Is it fear or is it greed? Extreme fear can sometimes signal a great buying opportunity, whereas extreme greed, well, that might suggest a pullback is just around the corner.
So how does it work? Well, the index gets its reading from 7 key inputs. Take market volatility, for example. That tracks the VIX, which you've probably heard called the fear gauge. When the VIX goes up, fear is increasing. Simple. Then there's put and call options. That just compares bearish bets against bullish bets. Lots of bullish call options? That points to greed. Oh, and junk bond demand is a great one. It looks at our appetite for risk. When investors are snapping up risky junk bonds, that's a pretty clear sign of greed. When you combine all of these, we get a really comprehensive picture of what's really driving the market at this moment. Okay, so while investors are out there celebrating, there's one group that's been in a really, really tough spot through all this, and that's the US Federal Reserve. I mean, this shutdown has created just a massive headache for the folks in charge of steering the entire US economy.
And this right here is the billion-dollar question, isn't it? The shutdown has completely halted the release of critical economic data. We're talking about the big ones here, the official inflation reports, the employment numbers, all of it.
So how on earth is the Fed supposed to make these huge decisions about interest rates when they literally can't see what's happening in the economy?
There's a great quote from the prepared resources that just perfectly captures the gravity of the situation. It says, "The Fed will be flying blind for its December meeting if this is not resolved soon." And that's exactly it, flying blind. Without fresh data, that's what they're doing heading into a really crucial December policy meeting. And let me tell you, that kind of uncertainty worries policymakers just as much as it worries the rest of us.
So if the Fed is in the dark, how do we get a read on what might happen next? Well, a really widely used resource for this is the CME FedWatch tool. What it does is it analyzes futures market pricing to figure out the probability of a rate hike or a cut at the next Fed meetings. Honestly, even without the official data, it's our clearest window right now into what the market itself is predicting the Fed is going to do. Okay, moving on. Beyond all the shutdown drama, we still need to keep our eyes on the global economic calendar, because there are definitely a few key events happening this week that could absolutely move the markets.
So, if we take a look at the economic calendar from a source like investing.com, we can see a few things on the radar. Japan's got a key bond auction coming up, which will be a really interesting test of appetite for its debt. We've also got important jobs data coming out of both South Korea and Australia, but the big one, the one everyone's going to be watching, is on Friday. That's when China is set to release a whole bonanza of data. We're talking retail sales, industrial production, the works. It's going to give us a major health check on the world's second largest economy.
So, it all comes down to this, really. The crucial question we're left with is, are we seeing the beginning of a truly sustainable new leg up for the markets, one that's built on a real economic recovery? Or is this just a temporary sugar rush, just a quick relief rally that's based on the hope of a political deal? That's the big question, and we'll all be watching for the answer in the days ahead.
This video is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion.
Thanks for watching. Don't forget to like and subscribe.